At a moment when people can't stop talking about the rise of the experiential economy, meaning that millennials don't want to buy things so much as they want to buy experiences that can be easily selfied, how do we explain the sudden weakness in the stock of Six Flags, long a favorite here? Here's a company that's the largest operator of regional theme parks in the world, with 20 of them in North America. That sounds like exactly the kind of thing that should be working here, yet shares of Six Flags are down 13% year to date. Troubling. Well, when the company reported at the end of July, they delivered some disappointing numbers. Six Flags earned 59 cents a share when the analysts were looking for 70 cents. Its revenue came in weaker than expected, up just 4% year over year, and per capita guest spending was down 2%. Ouch. However, management was adamant that the weakness in the first half of the year was almost entirely due to the weather, and they explained that they think the rest of the year would be a lot better. So could this stock be ready to turn around? Let's take a closer look with Jim Reed Anderson, the chairman and returning CEO of Six Flags Entertainment, to learn more about how the company's doing and where it's headed. Mr. Reed Anderson, welcome back to Mad Money. Good to see you, sir.
Jim, great to be back.
Thank you, Jim. Have a seat. Before we get started, I mean, your company has long been associated with Texas. So, and I'm sure that there's some, you got some tough things to say about how things are doing there. So please, you got the floor on that.
Yeah, I think, Jim, just as you would feel the same, our hearts go out to the people that are affected by the storm. And from our perspective, we have 3 parks in Texas. San Antonio seen a lot of rain, so over the past weekend we closed the park there. Yeah, and it has an effect on the Texas parks. But as you started to state when you were describing the opening, we have 20 parks, and we have a whole year in which to operate. And we find that over a season, over a full year, we find that people tend to come, even if they don't come earlier on because of weather.
Okay, now, we said returning CEO. Let's deal with this. What happened here? Oppenheimer, in a report calling disappointing second quarter 17, I don't know whether they have any edge or not, but they start out by saying, in a disappointing release and one that provides a potential explanation for the sudden retirement of John Duffy last week, the previous CEO, Six Flags reported adjusted EBITDA of $166 million versus our estimate of $178 million. True or false?
So the truth is that we did miss the analyst estimates, and we personally were disappointed where we finished. But let's be very clear. John retired for personal reasons. And when you look at our performance, we had record revenue and record profitability in the second quarter, even though it wasn't where we all wanted it to be. So we know that we can do better. And the reality is that I think there are many reasons why we are going to do better, and I'm looking forward to talking to you about those. In
a second, but first I just want to, final clarification, we said goodbye to you because I thought you wanted to go do more things. And Mr. Duff is 56, I'm 62, I'm not going anywhere. So there is a bit of like, what are you doing back here? And that's early retirement.
I look on it as a huge positive.
Okay.
So remember,
I do too,
I'm one of the,
I want the stock higher.
I'm one of the top 5 shareholders in the company. And even last Friday, I spent $3 million buying the company's shares because I believe that the stock price where it is today doesn't reflect the true value of this company. A 5.1% yield, Jim. That's the highest yield in the industry. And so right now it's an opportunity. And if you go back and look at the last 7 years, 6 of the 7 years, in this third quarter period, our stock's gone down. In fact, a year ago, we were pretty much at our 52-week low. So there's a trend that tends to develop, and this is a perfect time to buy.
Well, let's talk about the longer term and why you would be buying that. You've got adjacencies you're starting to talk about. You got water parks. You obviously have this international expansion that's terrific. And then something else, which I just think people really need to know, is there always has been a genuine catch-up. I don't think people really believe that.
Yeah, I think it's a really good point. And what I would say to you is, look, Jim, there are many reasons why this is a good company. And the most important is, long term, we see huge opportunities. This is a great industry. In fact, it's a recurring revenue industry. And it's very stable, even in a downturn. We're the best brand. We're the most famous brand. If you think about regional theme parks, there's no better brand, and it's truly a global brand.
But people say, wait a second, if this happens with EBITDA, will that mean that the distribution may not go up? I know that's up to the board.
No, but we've said very clearly, if you look at our goals, look at the $750 million of modified EBITDA goal that we have, that we see the opportunity not only to increase our dividends in the high single, low double-digit level, but also to buy back shares in that period of time.
I thought that was very interesting, buying back shares. Now, one of the things I think people don't understand is, in the whole time that I've been talking to you, I don't think anyone else has been able to build a theme park. from scratch.
Absolutely.
Because the barriers to entry here may be the highest. So, again, I need people to understand why that is, because people say, why can't I put up a theme park?
Well, people who have put up theme parks have failed.
Yes.
They have failed.
They fail.
So it's one of those things where people speculate that there's a theme park coming, but there's nothing competitive with our theme parks. It costs $500 to $700 million if you can get approvals to build a theme park even.
Meaning that it's very difficult environmentally, it's very difficult in insurance. I mean, you've got the great safety record. If you start from scratch, you don't have any record.
You don't have any record, and we've got 56 years in this industry of proving that we can do this, and we have 20 parks. We've just taken over 2 parks and opened them up. So,
And you talked about the Mexico experience. I just think, and I know we're going to run time, but that Mexico experience is a, 40% increase the moment that you did
40% increase in our season pass sales, Jim. And I think, look, I'm going to say some things to you.
Sure. No, I want
First of all, we have so much opportunity in season passes. Right. Less than a third of our guests, unique guests, own a season pass. Right. We're only halfway through, maybe the 4th innings on our pricing opportunity. We've got this thing called the all-season dining pass, which is a tremendous growth opportunity. We have low penetration still. We've got international. And then on top of that, these water parks. You add all of that up, it's opportunity just staring you right at the face with a 5.1% yield.
Well, that's why I'm so glad you're on, because I've been out there saying, listen, this is just the most consistent one. Look you in your eyes, listen to this. I totally agree with you. That's Jim Reed Anderson, the chairman and returning CEO of Six Flags Entertainment. You can't find good yielders, okay?
Jim, I've got one more for you, though. You can't leave without me saying this Thursday, we're launching our biggest ever season pass flash sale. Up to 70% off, blow the roof off. You'll never get a better deal than this.
Fair enough, right there. Mad Money's back after the break. Thank you, Jim.
Thanks, Jim.
Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.